Loopnet. So I think we are good to go, guys. Hey, hello, hello. What's up, everybody? It is a wonderful Tuesday here in Atlanta. My name is Majesty Gale. I am a real estate developer based out of Atlanta. I focus primarily on multifamily properties in urban locations. And I'll do some mixed use stuff now as well, but I started out doing single family homes and work my way through retail, office, some of everything, even some modular housing. So yeah, pretty extensive background. I do this content, daily. I don't know how long I do this for, but for the foreseen future, I'll be doing a weekday video every day. And today's segment is basically where I go through a deal. I think we'll start calling it Back-of-the-Napkin Tuesdays. It's where we look at it. I do it live. Well, I'm streaming or recording, but I do it actually as I'm recording. It's nothing that I have prepared that I'm coming with. I just look for a deal on the internet, record that, and then do a back of the napkin, which means a very quick and dirty like underwriting to see if it even makes sense. So yeah, let's hop into it for this week. Last week we did a new construction single family project. There was a house, we found a lot, and we looked at what it would look like to build something on that lot. This week we're gonna do a multifamily acquisition, like we're buying an apartment building, an existing apartment building. So we're not building one, we're looking for something that already exists. And I'm using Loopnet to search for this deal. I know everybody has their feelings about Loopnet. It's like the graveyard of commercial real estate. That's what people say. And it's somewhat true, but that's what I'm using. That's what everybody has access to. It's free. You have CoStar and Crexy and all the other stuff. You can deal with brokers and get stuff. And, there's other ways to go about it, but I'm using Loopnet. It's free. It's actually owned by the same people that have CoStar, so a lot of the same information, just not as detailed. But anyway, without further ado, so we're looking at for sale. I'm gonna take off the boundary, open it up a little bit, and let's go to the filters because it's showing everything right now. And I have this notepad up for notes, obviously. There we go, multifamily. What options they got? That's leave that there. We're looking for Atlanta. Let's stick with Atlanta. We're not looking for business for sale. That's fine. That's fine. Do not include condos. Please do not include condos. Condos, portfolios is fine. I'm not a big fan of the auctions, exclude pending sales. We'll still look at that. No need to put distressed. We'll be able to see that. Just trying to keep it kind of open, so we'll see what this comes back with. Okay, yeah, that shut it down a little bit. I'm gonna remove the boundary again. Oh, wow, I'm actually familiar with some of these problems. I'm familiar with this one pretty intimately. So let's zoom in. This is 285, the interstate that kind of goes around actual Atlanta. So I'm gonna use that as kind of my barrier. So let's look at it. I'm familiar with this one, so I don't want to look at it. I don't want to bring anything to it. I do not know this property. I've seen this one before. And that's kind of what is meant by CoStar. It's kind of a graveyard. Stuff just goes here and sits until somebody decides that, until something. Sometimes it just sits. So, yeah, I'm familiar with that one. I'm just looking for a good, I prefer 32 or more units. So that's kind of what I'm looking at. Oh, perfect. Looks like 32 units, exactly. Let's see what we got here. If they're not condos or something weird, then I'm going to use this one. Dream Court, I has a solid rent structure, blah, 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 Dream Court. Yep. So this looks like this is pretty good. All right. So we're going to use this property. Let's go ahead and just write down the initial 2410 Benjamin Mays, 32 units. They want 3.3 million. That's about 103,125 a unit. And let me put this is in 30311 because that's going to be important. Okay, so now what we want to do is try to guess. I won't say guess, but estimate the finances of this deal. If we were doing a back of the napkin situation. So we're going to assume that it needs work. They usually show the best thing that they have available, like the most recently renovated unit. So we're going to assume that all the units need some work, or at least kind of a rule of thumb across all the units. Maybe not all the money goes into all the units, but that amount of money will be spent on something. Says it has a 94% occupancy. I'm guessing maybe it has some vouchers or something like that kind of tied to it. Represents the estimated rate, occupancy rate. So now what we're going to do is not guess, but find out what the rents would be in this area. And there's one way to do that with a uniform 2-bedroom. So they all have 2-bedroom, 1 bath. So that's the one thing we definitely need to know is our unit mix. It looks like they're all 2-1, 2-1, based on what's said here. And obviously we'll have to verify all the information that's given here. But for right now, we're using the information that was given like it was true. We're just giving them the benefit of the doubt until we get the finances and do our due diligence. But just want to see if there's a conversation even to be had right now. 103 a unit is honestly not too bad in this market. I hate to say it. It's C class, so that lets us know our cap rate actually needs to be closer to 7% or 8%. I'll explain that a little bit later, but that's basically the price that you'll be buying it at. The lower the cap rate, the higher the price. The lower the cap rate, the higher the price. It can get confusing, but the lower the cap rate, the higher the price. We need our cap rate to be higher, which means the price we're going to offer lower than what they have here. I can already tell you that. So anyway, we got the 2-1s. Now what we're going to do now is find what the market rents are in the area, and the best way to do that, in my opinion, from where I work, as far as our strategy, we deal with affordable housing, we deal with a lot of government funding. So we use the government and their data in order to estimate these amounts and these rates and everything. And it goes hand in hand with getting vouchers, which most of our residents have vouchers or some type of rental assistance like that. And HUD is the kind of the standard for that. HUD sets these rates, and 2025 income limits. And it's very easy to see. Like, I mean, you're watching me do it in real time. All you really got to do is take the area that you're in, and go to the area that you're in. I'm in Atlanta. I know that 30311 is in Fulton County, even though I think you can search by zip code. So anyway, so here we go. So this is Atlanta. This is showing like all of Atlanta as well. You can get deeper than this. And actually, I'll show you guys as well. Why not? But these are the income limits. So when they say median family income, 80% AMI, you hear stuff like that. This is what they're talking about. It goes down to 50% AMI and even as low as 30%, which is considered extremely low income where you're, making this amount of money. So they do all the background on income and all that stuff like that, and we just use their information. There's no point in trying to recreate that. So let's go look at the fair market rents now. And this is where you can get more detail and look at the actual zip code of where you're looking for. And it has everywhere in the country on it. So that's hold on, Georgia. Yeah, but it has everywhere in the country on it. So Very easy to find your location. You'll see in a minute kind of what this looks like. There we go. All right. See, now it's showing you all the zip codes. And at the top, you'll see efficiency, which is a studio, 1 bed, 2 bed, 3 bed, 4 bed. And these, the FMR stands for fair market rents. Small area fair market rent. So you'll hear SFMR, that acronym. That's what they're talking about. So let's go find our situation. We got 2 bedrooms, so we in this third row right here. But let's go find what our like market rates would be for this. We won't get the actual rents until we get the financials from the owner of this property. So this is what we're looking at here as far as market rents. And hopefully that makes sense. We're in 30311 is the zip code for the address. And then we just went, this is a studio. This is a 1 bedroom. This is a 2 bedroom. We have 32 2 bedroom, 1 bath. So that's how I came up with the $1370 a month. This is HUD once again. So this is the government. They did the research. They did the calculations. This is what they came back as a fair market rate for this zip code. Of course, there's some variables such as finishes and stuff like that that may cause this to fluctuate. But this is, remember, back of the napkin. We're just trying to see what we have going on, and if it makes sense to have a conversation with the seller. So with that said, now we need to find what the overall revenue of the property can generate, assuming that is 100% filled. That's called the gross operating income. No property typically is 100% full ever because there's always somebody moving out or moving in or something like that. But we'll back into the actual number, but we're starting with it like it was 100% occupied. So, and I'm just going to calculate all of this stuff in real time. May make some mistakes, but it'll be a good learning experience for everybody. So we got 32 units, right? And we're saying that the market rate is $1370. So that's how much we're looking at monthly. Everything you do typically in business, especially when it gets a certain size, you always want to do it annually because that's just how things typically are calculated. So we're going to annualize that as 526. Wait, 526. All right, so we got our GOI. Now we're going to do our vacancy. We're going to go ahead and put in a pretty healthy vacancy to be safe. And a vacancy is just what it sounds like. That's how many people don't live there. We're going to be conservative in our approach here because we don't want to pay too much for this property. I know they said 94 or something like that, 95, but we're going to be conservative. Plus, sellers and brokers lie. So we're going to be conservative and go with 10%, saying it's going to be 90% full. So that 10% is, just 52,608. And then you take that amount away from the GOI. 608. You could add other income, but this is a very small property, so I don't think it has much other income like laundry and valet trash and all that stuff like that. So I'm gonna leave that out for simplicity. And this is our effective gross income now. So, and this can include concessions as well. So I'll just include that. So basically, if it was 100% full, you get 526 a year from it. And assuming it's 90% full, you're gonna get you get a little less from it. The 10%, less than 10%. So, with that said, let's go ahead and now look at expenses. We now have to take expenses away from it, and we're just going to use a rule of thumb here. Once again, we'll go way into more detail when we get the financials and we do our appraisal and our inspection, and then we'll have more objective data to work with. But right now, back of the napkin, just trying to see if it's worth a conversation at the 3.3. Right now, I don't know. So that's what we're looking to see. So expenses are going to be 45%. We're just going to go ahead and say 45% is a good rule of thumb there. So that is, and I'm just going to round, for right now, just for simplicity. So we have 213,000 there. So let's go ahead and remove that from there. So this leaves us with our NOI, which stands for net operating income. And it's very similar to EBITDA. So this is the main number you're trying to get to understand what it is that you'll be able to offer on this property. We're gonna go. We can go another level further to deduct the debt service, because you're gonna get a loan to buy this property. The NOI is basically the amount of money you would make if you bought this property cash every year. If you bought this property, if you paid cash for this property and didn't have a loan on it, the $260,000 is what you would bring in after expenses every year. But most commercial real estate in general, is purchased with a loan. So now we can look at taking the loan out. But before we do that, let's see if their price point is any good. Is it realistic at all? So I got that amount as NOI. So we really want to target 7 to 8% cap rate. And that's just kind of what the market, or what you want to enter the market with right now to get a good deal. You want your cap rate to be higher than your interest rate. Interest rates right now are ranging between, it depends on what you're working on, but anywhere between about 5.5 to the like high fives. Let's just say 6, or say 5.5 to 6%. So you don't want your cap rate to be 5.5 or 6%, because then you're breaking even, or on your rate to cap rate kind of comparison. But you want your cap rate to be higher. The difference between your cap rate, say your cap rate is 7% and your interest rate is 6%, that 1% difference is where you make your money after you pay your debt service and everything like that. So essentially, we want our cap rate to be above 6% to be profitable, but we really want it to be at 7% or higher. The higher that it is, the more profitable it is, but also the more risky it is too, because there's just more risk, more reward. So anyway, let's just assume that we're going for a 7% cap rate, and that means that based on the market rate, we could pay $3.7 million for it. Now, that seems high. Definitely seems like something's off. Once again, this is back of the napkin, meaning I don't have any objective information from them. I don't know what rents they're charging right now. I just know what the market rate could bear. Now, what I have to do to get it to that point is a question, and that is what will have to be deducted from this amount to come up with the actual offer that you would make. So let's just place the value at this 3.7 million, right? 10% cap rate value. And this is just back of the napkin. So let's look at it like that. But either way, we know we're in the wheelhouse. They're offering it for 3.3. So remember I said that we're going to assume that all 32 units need some work. Let's say that they need at least $10,000 worth of work, right? So that gives us a $320,000 CapEx budget, construction budget. So just say they need at least $10,000 worth of work to get to that. So now we're taking that away. We're removing that amount from the 7% cap rate value that we came up with. And that is saying ultimately that we could offer up to $3.4 million for it. So is it worth a conversation? Yeah. I mean, you'd have to look at your debt. You'd have to look at a lot of different things, but it's worth picking up the phone, contacting the broker or the seller and having a conversation, because there's potentially some money to be made here. Once you get more information, you may find out that the rents are only $1,000 a month. You know, half of the tenants are behind on their rent. You know, 2 of them have been are going through the eviction process and won't leave. You never know what you run into. There's a burn unit in the back. Something just got flooded. So there's a lot of things that can happen to kind of blow up this back of the napkin look at the property, but it is worth the conversation because you can always negotiate the price down, work out whatever terms, or you may be able to figure something out. Like we get a lot of grants and different things like that into our projects. So, that may be helpful here to get a grant or to get something like that to bring the cost down. But anyway, I think that's enough for now. Don't want to overwhelm anybody or put too much information out there. Just kind of wanted to run through what looking at a multifamily property like this looks like. Even at the 3.3 million, let's just say that we made sense of that at the price point that they're asking. Just so you guys know, like nobody's expecting, well, it can happen, but nobody's expecting you to come with $3.3 million to wire to them. You would get a loan for this. And, you would bring anywhere from about 10 to 20% down, maybe less, depending on how you put it together. I work with the city of Atlanta. I would ask them to put in, some of that money, if not all of it. And I also work with some other funds and organizations that are putting that money like on your behalf. They want a piece of the deal, obviously, but it can work out that way to where you don't have to put the money in. So I just wanted to show you guys this. This is a real deal. You could look up this on it right now, April 29th, 2025, and see this property, and it's available for you to call or message on. I think I'll actually check it out just to, be aware of what's going on in my market. I like to keep up with these are the type of projects that we do. I probably put more than 320 into it. I probably up that just to get the outside. I think it looks nice. I think it just use some updating and also on the inside. But either way, you guys kind of understand how to do this now. It's really simple. Anybody can do it. Multifamily commercial property is attainable for everyone. You don't have to be a genius or a rocket scientist to do it. So hopefully this was helpful. And if it was, please like, share, subscribe, comment, all of that stuff. And I'll catch you guys tomorrow on the next video. Thank you. Bye.